a real estate asset is great to invest in. I love it because it has a real address. It's something you can see, touch, and hold. However, the way we participate as investors in these deals has a capital stack, has a financial construct. And those types of things, everything from the business plan that the sponsor runs all the way over to what type of loan do they take out?
Mhm.
And what are the terms of that loan? Who is the lender for that loan? Those are really big questions. And those are just some of the examples. The approach, the debt, the capital stack, the team structure itself, all these things.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. And this episode, I'm chatting with Spencer Hilligoss of Madison Investing. And Spencer's somebody who's been in the business for a long time now at the commercial real estate level. And obviously, we're going to spend a lot of time in this episode, or most of the time in this episode, talking about multifamily investing. But somebody who has a really interesting background in that started in the tech world and built a very lucrative career in San Francisco in the Bay Area. I'm working for various different companies in various different roles, but the through line being, high growth kind of tech startups, tech worlds, and at some point realized, hey, I gotta start getting my money into asset classes that are actually going to pay me on a more consistent basis, which is how he ended up finding real estate as an investment asset class. And we talk about why he started actively investing versus passively investing, and what some of the key decisions were around focusing on the active side before deciding to passively invest. And then we talk about the shift into passively investing, and then above and beyond that, actually starting Madison Investing and what he's been able to grow within that business as it relates to raising capital from other LPs and pursuing deals both in multifamily and then in some other asset classes as well. Spencer is an incredible communicator. He's somebody who thinks oftentimes in frameworks and does a great job of communicating how he's focused or how he's actually focused on the different components of his business as he's grown his business. It talks about the 5 point framework for evaluating deals and sponsors, which I think is really helpful. And I think this is a great episode for both LPs who want to better evaluate passive investment opportunities, but also for the active investors out there who want to start raising capital and want to figure out how they can actually start getting those first handful of dollars across the door. And then above and beyond that, actually scale the platform a little bit, right? And that's what we talk about in this episode is, all right, you want to start raising money, where do you start? And now that you've raised some money and you want to start raising more and actually really growing your platform, what are some of the key decisions that you can make along the way to actually scale the business, right? And scale your efforts from a capital raising standpoint. So I very much enjoy my conversation with Spencer. He's a really bright guy. And like I said, he communicates his thoughts extremely well. And I know that you guys are going to get a ton out of this episode. So if you did enjoy this episode, please leave the podcast a rating and review. Send it to someone as well if you think they'll enjoy it. A business partner, a colleague, just anybody in your personal network who you think might enjoy it, who may be interested in passively investing in real estate. Again, this is how the show gets in front of more folks and helps the show grow, fundamentally speaking. So again, thank you all for listening and enjoy this episode with Spencer Hilligoss. All right, everybody, welcome back to the Multifamily Wealth Podcast. Joining me is Spencer Hilligoss of Madison Investing. And as you just heard me run through, somebody with an extensive background as it relates to, well, both personally investing in multiple different asset classes within the overall real estate sector, but also someone who's raised capital from LPs and invested it into into multiple different asset classes, of which we'll primarily focus on multifamily here in this show, I'm sure, just given that's the audience of our show, of course. But somebody with extensive experience, both raising capital and vetting sponsors, and also just somebody who has a good understanding of how to evaluate risk, opportunity, et cetera. And I'm excited to get into our conversation here, Spencer, because as we just briefly discussed before I hit record, interesting times to be evaluating deals and sponsors and maybe markets too. I mean, that's also a very under discussed component of these conversations right now, I think, as well. And excited to get into what you're up to today and how the business has evolved. But let's start with your background. Go back however far back you'd like to go, but would love to learn about how you got into real estate, maybe what you were doing beforehand, and how the business has evolved since you got into real estate itself.
Yeah, well, just a pleasure to be here, Axel. Thanks so much for having me on. It's great to kick off the year with you because, man, to your point, what an interesting time.
Yeah.
So, to say the least. So, here I sit leading Madison Investing. It's our passive investing club. We've now exited over 20 deals, full cycle. You kind of called out the key assets, multifamily being the primary over this journey. But to step back, so I actually grew up in a real estate household. My dad was a broker in the Bay Area, California. So I live here in Alameda, a little island next to Oakland, across from San Francisco with our two kids and my wife and co-founder, Jennifer. It's been a remarkable journey from that time opening houses, doing open houses and cleaning out fridges for my dad's properties as a teenager. And I ran screaming from that into the tech world because I thought real estate was, that's all that was involved. Is like glad handing people, showing them properties because I was being told to by my dad, cleaning out properties, etc. And it wasn't very cool to tell my friends in Silicon Valley, hey, I'm going to go and do an open house this weekend. So flash forward, I went through 13 years in Silicon Valley tech companies. And I really stumbled my way into a reluctant leadership career in building operations and sales teams. I was up to 200 people in my span of control by the time I was 26. And I was way in over my skis at that point. That's how you learn, as you know. But I think I look at that career and this journey that's taken me on, and I'm just so grateful for it. It's been within largely financial tech companies, so like Intuit, Zero, Gusto, Stripe, companies that solve like the back office for small businesses usually. And so that was a really cool and really fun, and still is a fun journey, just to be able to go and understand how you go to market and all that stuff. But that did not teach me anything, I felt like, about what does it mean to go and build any form of moat around my family beyond the day job. And so around 2016, Jennifer and I said, let's go do this. Let's bite the bullet, start learning how do we go beyond just our day job. And I thankfully, mentor of mine in my W-2 career nudged me into this one company that was actually lending to fix and flippers. And this is Kiavi. They used to be Lending Home. So shout out to those guys. But I didn't know the first thing about this stuff. I didn't know the first thing about investing in real estate. I had spent time in real estate, sure, but brokerage is not the same. And investing your money into rentals is where we started to go with this, because I saw all these colleagues of mine flipping on the weekends. And I'm like, I cannot swing a hammer. I know a spreadsheet. I know business partnerships. I know how to analyze some of this stuff. But how do I go and actually get involved in a way that can de-risk some of my family's financials? Because two active incomes, Bay Area household, that's all going well, maxing out 401ks. I didn't see an off ramp though, from the tech career. I was burnt out, admittedly. Couple young kids, scarce time, working 80 hours a week in an office. I was like, where the heck is the off ramp, man? So ultimately started buying some rentals, and we can kind of go into that if it's helpful at some point. But that ultimately led me to being like, well, 6 figures of down payment for our first rental in the Bay Area that generated $200 a month in cash flow net. It's not exactly a life-changing moment. It's gone up in value, sure. And we bought more rentals after that. But that led us ultimately to investing as an LP. And we've done that many times now, and also just done capital formation work. And we run Madison Investing to help other investors hopefully try to de-risk how they go about this stuff now. And it's just a pleasure.
Love it. No, and that's great context. I live in Boston. A lot of my friends live in Boston. A lot of my friends, who used to live in Boston, they took jobs in New York or moved to other major cities. And just at a personal level, the amount of conversations I have with folks that, I grew up with or I went to college with or connected with through mutual folks who are working a high paying W-2, and they understand that, hey, probably a similar realization that you had where this is great. I'm getting hammered on the tax side and I'm maxing out my 401k, and I put a couple bucks in a Robinhood account and buy some ETFs, but like there's no real, it doesn't really feel like there's any, momentum building as it relates to actually generating cash flow or actually, putting themselves in a position for there to be key capital events that help to accelerate the wealth building process. And it's like, all right, let's go take a look at real estate. And here in the Boston area, I'm sure very similar to the Bay Area. It's okay, I can go buy a duplex for $1 million, but like, where is that really getting me? That's
Exactly right.
that's not a roadmap to replacing any meaningful portion of my income. Even if on paper I can earn some nominal single digit return, maybe double digit return when I, account for leverage and some type of IRR calculation. But it's not a fast path. So I'm curious to you. I mean, you just described that pain point. How many, rentals did you get to, or what was the triggering decision to say, hey, maybe I should just go passively do this with some other folks that, maybe are investing in different markets where the economics might be a little bit more favorable to me? And what were some of the early steps you took to actually start finding some folks to invest passively with?
Yeah. I mean, and to your point from earlier, with the Robinhood call out of just auto investing in that too, I like to make it very clear for folks that are getting to know me for the first time and when I'm helping others set goals. Like, I am not the guy who myopically says, go all in on real estate with your entire portfolio. Of course, like it's all about balance, right? So do we still do that? Do we still auto deposit into index funds? Of course we do. But a significant portion of our personal portfolio has been allocated into rentals, into alternative investments, largely within like commercial real estate. So to your question though, Axel, we got up to six rentals that we owned outright. Did that first duplex in California. It was, 430 grand purchase with 100K down. In hindsight, pretty good loan,
Yeah.
of course, but we went out to the Midwest once we realized our dollar could not go nearly as far as we wanted it to. Here, similar dynamic to what you described in Boston. And we found this is at the time 60K purchase price on average in Kansas City. I don't know if you could find that now, but you can get it at that point 250 bucks a month net cash flow on average for those five properties we built up. And that was mind blowing to me at the time, right? I was like, wow, if we can keep doing this, this is going to go very well. But then ultimately, we learned rentals are semi-passive at best. And once we
Hmm.
got, basically the notice about the couch on one of the properties that we got like multiple kind of complaint issues because these were C-class properties, that one of them had significant turnover costs at the end of the year because someone had done some damage to a property. You learn all those different things about, wow, yeah, even with a property manager taking, a percentage every month, you're still doing work. Like you're still having to do some of this stuff. And we didn't want to add more overhead to our lives. We're trying to be good parents and juggle the W-2 careers and layer on these rentals that are supposed to be a passive, thing for our portfolio. So that was, I kind of look at that as phase one and two of a three-phase thing for us. In hindsight, I'm a big kind of rubric and framework guy. It helps us make hopefully smart decisions quickly when it comes to pulling the trigger on some of these deals we want to invest in. Phase one, buy local. Phase two, buy long distance and try to do that the right way. Phase three, okay, we got to find something else. Like we got to find a way to go and put 50K, 25 or 100K or more into something that's actually passive. And we started investing in our first multifamily deal. This was in Alabama, and it went full cycle within 2.5 years, which was obviously helped by the timing. But the team did a great job too. We got into that, I think, at the tail end 2017, maybe the beginning of 2018. And then we exited rather quickly. And I was like, wow, there is work on the front end. This is the one thing about passive investing that I feel like I wish everyone would just be straightforward about, which is it's absolutely passive once you're in the deal.
Yeah.
You
Yeah.
still, I mean, we all still have to read a brick wall of text known as the PPM, the private placement memorandum, right? We still have to go and digest a lot of that legalese. But that was the first real deal we got into. And then we started to look at other markets. I'm a big fan of Dallas Fort Worth at large, huge market that's treated us very well. I've also looked out east, to the Carolinas and a few other places in the Rockies as well over that time, and branched out to other asset classes such as self-storage, mobile home parks. But multifamily is still the primary asset class that we've looked at in commercial real estate to date.
Love it. Yeah, and I think it's interesting because I think there's a lot of folks, as you described, where there's the perception that when you buy a rental with a PM, maybe you have a few conversations a year, and that's the extent of your time investment into that investment itself. And that's like maybe that's true with a nice single family where it doesn't turn over that much, and there's really not a lot to discuss. But even outside of that, you still have to prep the tax returns every year. You still need to renew the insurance every year. You still have to, there's probably some level of billing that you're responsible for. You're probably getting the tax bill for it. And then during the key events throughout the lifetime of owning the property, where sure, your property manager probably has some context of which, or a better context of which to recommend what you list the unit at to rent it for. Or the heating system blows up and you got to replace the heating system, but maybe it actually makes sense to convert it to a completely different heating source, and that's more economical. And there's a lot of these different things around the edges where, and you layer on having six of them, right, on top of it, right? You're 6xing the volume of decisions you have to make. But maybe you're not even investing that much time, but you're also probably not in a position to make the best decisions when it comes time to make the decisions because you're not in this every day, right? And that's what I always tell folks,
Totally.
where it's like, yes, passively investing, you are saving time. That's fundamentally probably the most advantageous benefit in doing so is, yeah, you're throwing your dollars into, if we're talking real estate here, in a much more passive capacity. But what I think is arguably even more critical is you're outsourcing the decision making to someone who is far better equipped to make the right decisions than you would be when you're not in real estate, right? And
Totally.
I think that's an underrated part of this. Now, obviously, that assumes you're passively investing with the right person, the right group, the right operator, et cetera. So let's go back to that first deal that you guys passively invested in Alabama, and maybe talk about, how did you even at that time find the group that you wanted to sponsor with? How did you get connected with them or source them or what have you? And what were some of the very early things you did to perform diligence on them? And then I'm sure you can see where I'm going. I'd love to see like the evolution of that throughout the years, which we'll get to after.
Yeah, happy to. Yeah. And I think you had a hit on one other key takeaway from the rental journey, which is that, hey, if we want to scale this thing, we're also signing loan docs. We're also doing all
Yeah.
the closing exercises on literally every one of those doors. And how much do we want to spend on those processes and all the other stuff involved, right? So in terms of the finding the first deal, gosh, I was mad. I was like a madman. I was networking in person at local real estate meetups. I was digesting content educationally like crazy. I mean, I've read 24 books in an 18-month period, which you don't need to do. No one needs to do that. That was procrastination. Listen to like 400 podcasts or something within a year. It just, of which many were helpful. And if I had found like your podcast earlier, like some of the quality stuff that is out there wouldn't have had to go so over the top. But I definitely educated myself and got very hands-on. I was on Bigger Pockets forums. I would take it offline with folks. And I think that's really important,
Hmm.
making sure that you take the time to connect with those people that you seem to resonate with when you go online. Like going online and meeting on forums is one thing. Actually reaching out individually and then talking to that human being on the other end of the chat, that's another thing. And really sitting down for coffees and taking the time, going to conferences. Like I was really all in. And I think that's where I met the first sponsor that I ended up investing with. And they at least passed the diligence for this 5-part framework that Jennifer and I put together. And this was just for our own LP investment. I mean, when it came to that first one, Axel, like we sat there and we're like, how do we get comfortable with this? Both Jennifer and I kind of come from operations and growth backgrounds within companies. So we like a good framework, and we put down this 5-part framework of kind of track record, team, approach, communications, and values. And there's a nerdy spreadsheet beneath all of those individual buckets. So we're not going to go into all of them, of course, but I would say those are the check marks that we saw that this sponsor met. And we've evolved that over time. But when we finally got down to it, what's remarkable about that first deal, and I want to bring this up as well, because I think it's something I would have wanted to know, is that even when you've done it right and you pick the right sponsor, what I didn't bring up about that first deal was that we didn't really understand what it meant to set cash flow goals yet clearly enough versus growth goals, because it wasn't a perfect deal. The headline of saying, oh, it exited in 2.5 years and it got a great 2x equity multiple. That's amazing. What I didn't say, and it's important for folks to know, was that a tree fell on one of the two buildings in a property portfolio within the first quarter and it wiped out the reserves because they had to fix the roof on this building. That was not part of the plan.
Mhm.
So what ultimately happened? Well, this was in the market was very strong. We had distributions paused on our first one. And I was sitting there going, okay, what the heck did we do? Lo and behold, the team communicated exceptionally well. The team provided financials that were detailed. They followed up regularly. And they were able to go and find a buyer on the other side of this once they still ran their value add plan on that deal and exited incredibly strong at the very end. And so I just like to bring up that color because ultimately we did all the steps that you could possibly do. We looked at the background, we looked at the track record of the sponsor, we looked at all these different assets, how they communicate with investors on prior deals, we looked at their values by doing some behavioral interviewing, and a tree fell on the building. It's like, well, there's no such thing as a perfect deal in real estate, period, right? And you know this better than anyone because you're an operator yourself, but all you can do is try to de-risk what is possible to de-risk. And in the end, once you sign that PPM and you wire the funds, it's so important as an LP to get comfortable with the fact that it is out of your hands and own that, accept it, and just watch your portfolio. And hopefully most of those will hit. Some of those won't. And I think we've gotten some amazing learnings from the past 2 to 3 years on that in particular, because the framework has largely served us really well as we've invested across all these asset classes across the country in different markets. However, some properties have done very well, but the deal structures themselves perhaps had some gaps. And we didn't, I think many folks didn't really know this until
Mhm.
the last 2 or 3 years, as we've seen some softness in commercial real estate and crazy high spikes of interest rates starting back in late 2022.
Yeah, and I think what was so interesting about the late 2010s, very broadly speaking, I got into this in 2016, grew a personal portfolio from 2016 to 2019, got to about 100 doors. And then it was like, well, let's start raising money to scale, the business from an operational standpoint, right? And that's the lens of which I viewed originally the whole environment of raising retail LP capital. And in my early conversations with investors at that time, where just again, broadly speaking, the market's humming, stock market's humming. There's a lot of folks who have investable cash. The all of the just the educational landscape, whether it's YouTube videos or podcasts or conferences or websites like Bigger Pockets, as you mentioned, those are growing exponentially. And the awareness around, oh, I can invest in real estate through this vehicle called a syndication, and I don't have to run it, and I can invest with somebody else who does know what they're doing and is, operating the deal, et cetera. And I feel like that was kind of that. It was the 2018 to 22 timeframe where that really exploded, and then very specifically 20 to 22, right, as COVID hit, and a lot of my early conversations with LPs, it was interesting being the operator having a conversation with a prospective LP who really didn't even know what they were investing in, and I could tell being the person having that conversation with them and spending some time actually educating them on like the nuts and bolts of what they were investing in. This is a preferred return. This is the split. This is what the capital stack looks like, right? We have a mortgage up to 75%. We're raising the remainder of the equity required to run the deal. Here are the terms around the equity. But a lot of folks just didn't even really understand that. They didn't really understand what they were investing in. And I think that a lot of those folks now have a thorough understanding because they may have invested in a deal that wasn't structured in the correct way, right? And I think that's what you're describing here as capital structure being a learning point for a lot of LPs over the last 5+ years. And, I'm also curious as to obviously having made dozens and dozens of passive investments, gone full cycle, and I believe you said 20 plus. Obviously, you've raised for multiple different asset classes and personally invested in different asset classes. If you were to go back and tell yourself back in call it 20, late 2010s, which it seems is the time frame of when you started passively investing,
Mm.
like ask more questions around this particular component of the deal or sponsor's track record, or spend more time actually performing diligence on this component of the opportunity? Is there something that really sticks out as like a hey, look, I didn't spend a lot of time on this, should have spent more, or this is where we spend more time
Mm.
now when we're actually vetting deals and sponsors?
Gosh, how much time do we have?
I know. Talk about a broad one, huh?
Yeah, yeah. I have to just pick a couple, right?
Yeah.
And these are some true heavy hitters. Let's talk about track record. Everyone says, look at the track record, and you have to. It's one of those duh moments. Like, do we want to go and look? Has this operator bought this type of property in this market specifically, and have they successfully run X or Y business plan that they claim they're about to go do? Have they done that before specifically? Now, I would say right out the gates, when we talk about track record, like why in our 5-part framework do we break out track record versus like approach? And what I mean by approach is very specific in this case. That means, okay, if this team is like, if you're in a business just working W-2, new project launches, you better believe we want to have a documented, proven approach and a framework, a plan, just a business plan to go do exactly what we're about to go do for some launch. If you're going to go run a value add plan on a multifamily building and you are new to, let's say you're an A-class multifamily operator, you've bought those A-class buildings and you're suddenly going to come out and say, I'm going to go buy a C-class building. Great deal, heavy value add. And you're used to putting in new marble countertops on an A-class unit. Are you prepared to go and deal with drug dealing on property? Probably not. Are you prepared to evict people for non-payment? Probably not. Like these are some of the realities within the approach differences. So if you look at a track record, there was amazing sponsor track records made in the year 2021, right? And you're looking at these peak valuations fueled by tons of printed money from the government. And then suddenly money and liquidity is floating around. So you've got huge spikes in valuations and a lot of exited deals. I'm grateful to have been in many of those exits during that time. However, there's a hangover.
Mhm.
And the hangover from that period of time is significant. And so you've got these track records for some of the sponsors that look incredible on paper. And I wish I had gone back in time on some of these deals and said, hey, like, I know you guys crushed it here, here, and here, and you're buying in the same market, and you've already proven you're strong on property management. However, why are you assuming a refinance is going to go well in year three? Even though you're assuming rates are going to go up, how far are you assuming those rates are going to go up? Are you assuming worst case scenario like a act of God black swan event style? Those are the key questions on the approach that I would pressure test a lot more because we really take our time. I fly out to assets, I look at the units, I walk to the units with the manager, all these steps that you could take, but you're still vetting humans, and this is not a perfect machine. A real estate asset is great to invest in. I love it because it has a real address. It's something you can see, touch, and hold. However, the way we participate as investors in these deals has a capital stack, has a financial construct. And those types of things, everything from the business plan that the sponsor runs all the way over to what type of loan do they take out?
Mhm.
And what are the terms of that loan? Who is the lender for that loan? Those are really big questions, especially if you're thinking about one other key call out here, which is, does that deal have a preferred equity lender in there? Which is a whole separate podcast about, geez, you really got to pay more attention if you had a preferred equity lender in there because they can come out of nowhere, even on a good deal, and say, we think you guys should sell now. And if they say that, which capital do you think is the first one to get wiped? Right? Like those are the types of scarier questions that I think, knowing that I'm a huge advocate for these alternative assets and will continue to be, and I'll continue investing into them, right? Like I'm investing in one right now. However, we go much deeper on the sharpening of the pencil. And those are just some of the examples, the approach, the debt, the capital stack, team structure itself, all these things.
Yeah, and you're right. This could be a whole separate 60-minute podcast where we just run down everything that has been learned both the hard way and then maybe from afar over the last handful of years. And because I think everyone who has both invested passively and then who has also actively raised capital from LPs and operated deals has a whole slew of different things I could bring up here. But it's like I'll just focus on one segment of what you just described and what I briefly brought up, where it's like purely the capital stack, because I think that's where many LPs, there's the biggest gap between the technical understanding of what needs to be asked and analyzed when looking at a prospective opportunity and kind of common sense, right? Where it's like track record, okay, we want to see people who have experience, who have done it, who have, as you've described, like who have done a similar type of project in a similar market. We know that people are moving to this market. It seems like the property is in good shape, but it's like, but there's you can download some level of common sense as a reasonably educated investor or successful W-2 employee or business owner as you go out there and start pursuing these types of deals. But like the mechanics of the capital stack, whether it's preferred equity or who is the lender in first position, is it an agency? Is it a local bank? Is it a debt fund? Each of those types of lenders has all types of different reporting requirements, different control provisions if a deal goes sideways. And it's like those are the really high variance drivers of an outcome, right? I should say, or those drive really high variance outcomes in terms of your triple loan covenant and this lender is chomping at the bit, ready to jump in and assume control of this deal. Or, there's some type of equity provision with one large JV partner who has some type of voting rights. And they don't, you don't really see that because it's, one line in the PPM.
Right.
I think that what's tricky is like that's also the hardest to learn, and that takes the longest to learn, and it's typically through some level of experience. But I think that is an interesting, point to just highlight as it relates to if you're a newer prospective LP right now, spend a little bit more time on that piece of it from an educational standpoint, in my opinion, and obviously continue to to perform the diligence and the other portions of the framework that you just described, which I think is a great consistent way of looking at deals. But nevertheless, we'll switch gears here a little bit because I want to talk about how you started raising money from other LPs, and I think this might be a portion of the conversation that's useful to the folks out there who want to go out there and start raising capital to fund their deals, right? The operators who listen to this podcast and are maybe starting from closer to zero than obviously where you're at now in your business. When did you decide that that was something that you wanted to start doing, raising capital from other LPs? And when you did decide that you want to do that, how did you, sketch out the actual framework of how that would actually be done? Were you doing co-GPs, fund to fund, stuff like that? Like what were some of your initial goals as you started raising capital from other LPs?
Yeah, happy to speak to it. I mean, it was so organic in hindsight. I was very much deep into the tech career at that point. And when you work inside the guts of a tech company that's also a lender for fix and flips, and we're doing 500, 600 loans per month, you learn things about underwriting that you never thought you would, right? And you learn how to look at the financial constructs of these things, and you just nerd out. And I was really enjoying that side of it. And so I was grateful to have a pretty robust network built up in the tech world. These are folks that are brilliant. IQ is way higher than me, right? I mean, we're talking like data scientists, software engineers, folks that are building incredible stuff. But they didn't necessarily want to get on a plane to go fly out to Georgia and walk a new property. They don't want to sit there and look at reports like from like title reports and look at inspections. And they just don't find that interesting. What they do find interesting is the idea of just diversifying away from RSU heavy company stock portfolios, index fund portfolios. And they just wanted to learn like how can I kind of sidle up next to you, Spencer? If you're doing all this stuff and you're putting your money into this thing, how can I also benefit from some of that education and resource? And so that's really where it started, Axel. Like it was just me investing and we were us grabbing coffees, going to lunches and saying, oh, someone else asking me, how can I maybe join you on that? And so as that began, I decided, well, how do I get involved more? And so I actually did join GP on a number of deals early on. And that's really where it started because I was also learning in my own right about how to get more active. And it wasn't just on the capital formation side, it was in the deal. And so that's really where that started. Now we will put together things such as like special purpose vehicles or SPVs, feeder funds to negotiate for better terms so that we can invest millions together into a specific fund or deal, get better terms with a particular sponsor and those types of things. But initially, it was joining on the GP, and it was just a labor of love. And I was building our investor network the old school way, and still do it now. We don't pay to advertise or anything. It's really just been referral driven, and largely folks saying, "Hey, I work in a tech company. This went well. Let me tell my coworker," and then they come in and find us through our website. So that's sometimes you have to do the unscalable thing. And I really still believe in that because I've gotten to know of our hundreds of investors, just like built these wonderful friendships and relationships, one epic conversation at a time, and trying to be a soundboard the same way that I wish I had had. Like it's so disorienting when you're first getting into this space, as you can attest to. And even though I thought I knew quote unquote real estate, I'm like, oh, I'm a homeowner. Oh, I've bought some rentals. Oh, I worked in my dad's real estate business when I was young. You don't necessarily, you really don't know yet. You got to get into it and humble yourself a bit and come back to some basic questions that I want to highlight here just for folks briefly, Axel, which is like, no matter how much someone knows about this space, everyone benefits from coming back to the basics on the question of like, am I investing for cash flow? Am I trying to grow the money?
Hmm.
Because I can't tell you how many times this comes up every single month is someone saying, "Hey, Spencer, will you give me some feedback on this deal I just found?" And I'm like, wow, that does look like a really cool equity growth deal. And I was like, why are you looking at it? Weren't you investing for a cash flow target you're trying to hit in the next 3 to 5 years? And they say, well, yeah, but the IRR is really high. And I was like, correct. Still haven't answered the question. And I'm asking this not to be combative. I'm just asking this to help you come back to center about why you're doing this in the first place.
Hmm.
Those kind of fundamental questions. And so trying to be a resource and sounding board as we've grown our investor community and most folks find that helpful. I find it helpful personally because I also am armed with a lizard brain that sees a beautiful looking investment summary and immediately says, oh yeah, wasn't I trying to hit a cash flow target? And all of a sudden this amazing looking IRR just totally turns off the critical thinking.
Yeah, I think that's a good question for the active folks to ask themselves as well as the passive folks too, because those are oftentimes people who forget that as well. It's like
Totally.
I'm buying this deal because it's priced at a good, price per unit, and I can likely refi pull my capital out. And then the downstream question is, well, what happens at that point, right? Is this a market or a type of, is this within the asset class that makes sense for what you're trying to achieve, which is maybe replacing some significant portion of your active income at your job or whatever. And it's funny how oftentimes we stray from that because an opportunity itself looks compelling,
Right.
whereas maybe it doesn't necessarily align with what we're actually trying to achieve. I'm going to ask you a question. I may completely botch how I ask it, but I'm going to try to
Fire away.
I want to try to do so in a way that actually gives you an opportunity to answer it. But, as you've grown let's call it the roster of investors who are investing alongside you within Madison Investing and really, grown that business into something that is obviously more sizable now than it was when you started it. Were there key decisions or like high leverage decisions you made along that path that really helped you gain traction or gain momentum? Maybe it was the email, email marketing or something like that, sending some type of consistent communication, or maybe it was, tapping into a particular asset class or market, or basically, it put another way, if you were to reverse engineer the success that you've had as you've grown it, and you were to point to a few different things that you've done really well that's helped that, is there something that comes to mind?
Yeah, I think the most important part in the first 2 to 3 years, roughly, is trying to identify and build super promoters.
Mm.
And those super promoters, meaning when we talk about doing the unscalable thing, this is one of those things that's just like a force multiplier. I don't want to put too many buzzwords to it, but there's no better way to say it than that. Like we have a small group of folks within our broader group of investors who are they're just incredible. Like they've exited multiple deals with us, and I remember on a couple of those occasions driving relatively far to go and meet them for lunch. And we're talking about taking like 3 to 4 hours for a single lunch, just going and meeting them in person. And obviously, there's been more since then over the years, but that has to be one of them because in the end, that one individual is, if you take care of them correctly, you show up with them for the results, you make sure that you're actually investing in that relationship. They become the person who says, hey, let me go inside my internal company chat and into our real estate investing club. And I don't mean me, I mean like at their company, their big tech company, and they say, you should really go check out Madison Investing. And that is it. I think oftentimes beyond that, there was a period of time, this is back in 2018 to 2020, roughly, where I was posting on LinkedIn every day. I don't necessarily think it's the same now. I think that not only am I not posting every day, but it's also just a different landscape. Like this is right before AI.
Yeah.
So at least in the popular sense. And so
LinkedIn feed is tough nowadays.
LinkedIn feed is tough nowadays, right?
Yeah.
And my hat's off to everyone playing the game. I just had to take a step back a while back because it's a labor of love. I did like 900 posts back to back manually, self-written, and I built some incredible relationships that way. But I look at that like it wasn't some massive way to get investors. It was honestly just trying to put some thought leadership out there. And I made probably more connections with prospective sponsors and operating partners and or JV partners than I could possibly imagine. Yeah, there was a handful of folks out there that tell me after the fact, they're like, I followed your posts for years, Spencer. And I was like, cool. Well, I mean, how come you didn't like any of them? But
Yeah.
in any case, the lurkers out there ultimately do sometimes reach out, and you build real world relationships from those things. And so I'm not sure where you can attribute how much the LinkedIn stuff helped relative to just building those deeper relationships in person. But I have to say the is the in-person relationships really that make the difference. Even if that means getting on a Zoom call with someone on the other side of the country. We have two investor personas if I were to pick them. Anyone who knows the kind of the term avatar or
Mhm.
ideal customer persona or profile, they know that like you build one, that doesn't mean you're limiting who you work with.
Yep.
It just means you're clearer on who you're targeting. And there's two. The primary is a technology professional. They've had at least 5 to 8 years of experience, probably dual income household. They likely have at least a couple kids. They maybe work for a FANG company. I know that's now been changed. I think the acronym is now Mango. I forget what, it's an
Maybe you
evolving
had to
space.
come in and screw it up, or no, they were a Fang. Yeah, they made it there, but yeah.
Yeah, yeah, and they had to change it up. However, we got really specific with that. And then over years, we realized like, oh, there's a second persona here. It's actually entrepreneurs and like successful nearing exit or post exit first time entrepreneurs. And it's just a pleasure to get to know some of these folks, like based in all parts of the country. Like then they're not even any way related to tech. So I think taking the time to do something, the last comment on this, Axel, this is an exercise that I did, and it was not an immediate payout in any way. I did the nerdiest marketing exercise when we first built those personas. I mean, I sat and I did 50 individual structured interviews, recorded them with the permission of the person, And these were just like first and second degree connections on LinkedIn with folks that I knew but I hadn't talked to in a long time, or maybe didn't really know, but I knew of them. And I went through that, and the point was to understand like how did they think about money? How do they manage their portfolio? How do they think about evaluating investments? And the whole point of that was just to refine the targeting. And in the end, like, if someone has asked me before, like, how many investors did you get out of that? And I was like,
Yeah.
that was not the point. Did we get a couple? Sure. But what mattered more was the insights. Just taking the time to not expect overnight results is important.
Absolutely. Yeah. And just as you described the fundamental, like returning to the fundamentals of why you're even making an investment. Are you investing for cash flow? Are you investing for growth? And how easily we can stray from that fundamental understanding of why we're making the decision to invest in a particular deal or in real estate in general. Same thing as you just described, right? For building relationships with investors. It's like fundamentally when you get in front of them or you get on the phone with them and it's a one-to-one conversation, that's going to help develop deeper relationships than some type of, hack or email marketing tactic or some type of AI enabled workflow that helps you communicate at scale a little bit easier. And I think as it's funny as AI produces more content, as we're joking about with like LinkedIn as an example of this, like the raw, authentic one-to-one communication is what is going to actually separate folks, I think, from
I
from
agree.
the pack. And even just the exercise of consistently posting on LinkedIn, for example, as you did, right? And for me at the time, because I didn't have a LinkedIn profile, I just started putting up a ton of pictures of what we were doing on Instagram. Like that's how I started meeting new investors or that, in terms of bringing them into our business was like before and afters of our apartment renovations and then just closed on this and a walkthrough of a unit and talking about exactly what we learned when we renovated it. And eventually you start to just attract people what you're doing. And the question that you just briefly asked as it relates, or that you mentioned that you have been asked of, okay, well, how many investors did you get from this? Was always an interesting one to me because I would get the same one. And I was like, some, a handful. I'm not exactly sure. We're not directly tying. Yeah, this isn't data that I'm very clearly tracking. But I think for me, what was most valuable is whether it was writing content that I would put on my Instagram story or writing content that I would put on LinkedIn or just doing like solo episodes on the podcast, it would help me clarify my own thinking around the business that we're in anyways and helping me to clarify what exactly what are we pursuing from an active investing standpoint? Like what types of deals in what market? Why do we want to pursue them? What do we do to them when we get them under contract? What's our business plan? Why do we like this area, et cetera? And just producing content fundamentally helped clarify it for myself, right? And helped to clarify my own
Totally.
understanding of what we were doing, which I think is an underrated benefit of doing so outside of meeting folks, right? As you described. Now, to bring this kind of full circle here into early 26 and to get a little bit of a, current events related discussion out of this, because I know that's why a lot of folks are listening to the podcast nowadays. They're looking for guidance, right? What should I be investing in? Where should I be, looking for deals, et cetera? The question that I have for you is, what types of opportunities excite you right now? Maybe what are you guys focused on within Madison investing? And why is that the case? And how are you going to look for those deals throughout 2026 or actually get into those deals?
Yeah. Well, don't have a crystal ball. I'll have
Yeah.
to give the disclaimer like everyone else does.
Yeah.
It's murky at best if I had one, but it's a time to be more excited. I think heading into this year, even if you look at the market at large, these are just my observations. I'm not telling people to go do any of this stuff. This is how I look at my own LP investments, right? But you have a unique time where it's like, well, okay, stock market's all-time highs, CRE, commercial real estate, coming out of a bottom. I mean, like it's like prices have been low now for a couple of reasons. So for folks that are just kind of getting up to speed on this for the first time, I mean, you and I, Axel, have been talking about the fact that it's been an interesting, challenging couple of years for commercial real estate, and the reasons for that are, well, there's a bunch of deals that basically decreased in value, in many cases over 20% at least, because interest rates were increased significantly. So, and also, the 10-year treasury, which drives mortgage rates, that's also been driving up high mortgage rates. So we've got a scenario where you've got oversupply also in some markets. So CRE and multifamily and some of the other asset classes that I like self-storage, mobile home parks, you've had some, oversupply issues there as well. So long story short, We're looking for deals that do allow for some actual meaningful downside protection. And so if I were to compare this to call it like the time period you and I were referencing, like the 2018, late 2010s timeline, at that point, you could find some characteristics of deals still, even though that was pricier at that point compared to the early 2010s, where you could basically buy anything and it was going to go up. You could still find a deal that was like, oh, in place cash flow, I could get 6% or eight, even up to 8% in year one. So if I invest 50K or 100K, I could start getting some cash flow from the operations of that property. And ideally, I could get some kind of equity multiple on that that was like, the quote unquote double your money in 5 years. I think that time when it's reliably out there like that way is past. However, we are looking at some smaller asset classes. I mean, smaller multifamily deals now. I would say a smaller to mid unit count. We were focused very largely on like 100 plus units previously. I'm open to smaller. I think that you could find a better fit. You can also find some really, really great opportunities there and some good downside protection for folks who know their markets really well. If you're investing with sponsors that are deeply embedded, they know their local markets, they know the competition, they have a good read on the supply or hopefully under supply in a constrained market. These are all things that I find more interesting now because we're sharpening our pencil a lot on multifamily to the point where it's like we're just basically saying no on almost everything because there's just even when we see a quote unquote good sounding deal and it has to have something kind of unique going for it, whether it's like you see some of the tax abatement structures that are out there that might be coupled to a certain deal, or when people say off market, that used to be able to if someone says they have an off market deal, it actually has to be a real off market deal.
Yeah.
It can't be a marketed off market deal because it's amazing how often that actually is out there.
It's
Like
a
if
word
some
that's losing its meaning, or a phrase, I
right,
should say. Yeah.
right. Has the operator been truly like reaching out to one specific seller for a couple of years and they finally got that buy-in? Like on one of the funds we're investing in now, the assets that's closing in that fund, this is like a 5 to 10 year outreach thing that the operator finally got their phone to pick up. So a unique advantage to be able to connect with those local sellers. That's the type of stuff that we're looking for is an actual deal, an actual off-market deal if we can find it. And when it comes to some diversification mixed in, I'm more pro fund now than I ever was. I think it's great to find individual deals. However, we're talking about for like the average passive investor, the average LP, if they truly want to have more downside protection and they want to, if they're investing, especially for like cash flow, a well-structured fund run by an experienced operator often presents a chance to get some more of that diversification and de-risking built in because you don't have one property being at the crux of it all, right? And so I think those are also some of the things that I look at. Not swinging for the fences on the projected returns either, man. I think if you look at the best exited returns that we've seen in the past, actually, it'll just take 2024. We look at 2024, the best exited deal that we had was the lowest projected returns of any multifamily deal that we've ever done.
Which
And
is, yeah. Most
it,
LPs are like, what?
yeah, I
Oh,
mean, but
yeah.
it was like a low teens projected IRR, and it blew that out of the water. But I do think that there's a lesson there.
Hmm.
And the lesson is number one, projected returns don't mean much, but
Yeah.
in the end, don't chase them. Just don't chase sky high projected IRRs. Go for the operator that has a solid operations team, a solid maybe integrated, fully integrated, ideally, and they're going for something that is reasonably conservative on their projected returns, and then let them beat them.
Exactly. Love all that. And that's a great way to end the show here. Spencer, where can folks learn more about you, reach out to you, all that fun stuff?
Yeah, and this has been awesome, Axel. Thank you so much. So you can reach me at madisoninvesting.com. Folks can just request an invite to our investing club, but they will have to talk to me, which I enjoy. It's like the most fun thing of my day to day is getting to know new folks.
Love it. Thanks again for the time. This has been great.
No, thank you, Axel. This has been awesome.